Many of you have asked me for an update on Berkshire Hathaway after the two recent acquisitions from Greg Abel's new CEO. He's been really busy and he's been proving a lot of people wrong, including Bill Ackman. And Bill Ackman said during the annual meeting that he believes Greg Abel is not going to be too active in his first year because he doesn't want to, upset Warren Buffett or looking wrong as he's the new CEO. But he's actually not scared of looking wrong. He's getting advice from Buffett, and he made some two decent acquisitions that I want to talk about in today's video. And I really hope you enjoy it as always. But you still, again, have a lot of people making fun of Berkshire on X and saying it's underperforming relative to the S&P 500. It has underperformed by the same margin it did through the global financial crisis. So that's a really big gap. And I see this gap as an opportunity. Now, the first investments they did is he acquired an extra $10 billion in Alphabet or Google. Before this acquisition, it was like their sixth largest positions. They had 15 billion in the company. Now they have an additional 10 billion. So in total, they have about 26 billion dollars, which makes it its fourth largest position in the portfolio after Coca-Cola. So Google is becoming more of a core holding for Berkshire Hathaway. And I like personally Google a little bit more than Coca-Cola and much more than Apple, so I think that was a decent move. But a lot of people didn't like this move because the stock is up 116% year to date, and they're saying, why didn't you do it in April? Why didn't you do it last year in 2025? Why are you buying the top? Why are you FOMOing in? Why are you breaking the discipline of Charlie Munger and Buffett about not paying up and doing all these things? Although those disciplines have costed them some gains along the way. So a lot of people were not really big fans of the acquisition. But there's two things to keep in mind. The first one is that Berkshire acquired those shares at a 10% discount to back then the initial price. The price back then was about $385. They got it for $348 per share and $351 respectively. So that was about a 10% discount. So they got it a little bit below the current price, which Berkshire likes very much. But the second reason why it wasn't really too bad is you have to look at it in terms of Berkshire's overall options. So they have about $395 billion in cash. They can't go invest in micro caps and small caps and mid caps and even some large caps. They need to invest in really big companies to be able to deploy the capital for those investments to move the needle. So they don't really have a lot of options. So for Berkshire, they mainly have two options. The first option is stay in T-bills and get a 3.5% yield. The second option is get Google at a 3.5% yield and have the earnings growth of 15 to 20%. So Google is not cheap at a 3.5% earnings yield with earnings growing 15 to 20%. But on a relative basis to getting a flat 3.5% on T-bills that could decline if the Fed starts to cut interest rates, it's not so bad, So it's more on a relative basis to Berkshire's overall options. They don't have many options. And that $10 billion, instead of keeping it in cash at 3.5%, he's getting 3.5% in Google plus 15 to 20% earnings per share growth. So it wasn't really the worst idea in the world. I'm personally a fan of the idea. Maybe it wasn't, again, a bargain, but it wasn't really bad at all. Now, the second acquisition they did of about $8.5 billion is actually they acquired the whole company of Taylor Morrison. Taylor Morrison is a land developer, home builders. They build apartments, but mainly a lot of single-family homes in California and in Florida and Texas and a few places. Their average sale price is about $578,000. So they're not playing on the big end like Toll Brothers. Average selling price is $1 million or $1.5 million. I think 1.2 million, I believe. So this one's about 578,000. Those homes, they sell much quicker, especially right now with high interest rates. People can't really afford, more expensive homes. So there are a lot of the $300,000, $400,000, $500,000 homes are selling really well. So they're in a really sweet spot. They already own Clayton Homes, which is a big home builders and a build manufactured housing as well, and that could complement their home building business. Now, they're using the NVR business model, which is mainly controlling the land instead of actually owning the land. So what NVR has been doing and what Taylor Morrison does is instead of them going and spending money to acquire the land and start building homes and doing all these things, they acquire an option to buy the land in the future at a specific price, kind of like stock options. It's the same thing with land options. So they get a land option and then they gauge demand. They see how much deposits they have, how much interest they have. If they have enough interest for the project to be profitable, then they exercise the options, they acquire the land, and they build the homes. If they can't really do it, then they just don't do it. And this is how they have 51% of the lots controlled instead of it being owned, which is actually really good for the company. Now, based on the valuation, they actually got the acquisition at a steal. And this is what this analyst said. He said, based on the recent completed transaction multiples, they paid about 0.9 times price to tangible book value. So that's really, really low relative to other transactions. 0.9 times tangible book is pretty much buying a dollar for 90 cents. That's really not bad at all in this market. And this is after them paying a premium. So that was, again, a really good acquisition. They have other acquisitions like Tri Point Homes, which was acquired by another company earlier this year. Well, this company paid 1.2 times the tangible book value, and you had MDC Holdings, which was acquired last year at 1.3 times tangible book value. So on a relative basis, Berkshire got a steal at 90 cents on the dollar for such a really good acquisition. So again, the CEO is making moves, he's doing a lot of things, and I really like it. I mean, I'm seeing someone that's aggressive, someone that's not afraid of making mistakes, and he's trying to deploy the cash position. So I'm seeing a lot of progress. And this is what Warren Buffett said during an interview with CNBC. He said, Greg did that faster than I could have done it, smoother than I could have done it, and I never talked to the CEO. He said he has launched, so he has started. And again, it was a really good acquisition, good moves, better than sitting $400 billion in cash and being afraid of making mistakes. He's doing a lot of things. And I really like what the CEO is doing, especially with Taylor Morrison. It's a free cash flow machine. Their free cash flow yield was like 17 or 18%, and they were using it to buy back the stock. So now instead of them buying back the stock, they send the cash to Berkshire, and maybe Berkshire can do something else with it and invest it in some places, or maybe even reinvest it in the business. So it's a cash cow, 90 cents on the dollar. A really, really good acquisition in general. Now Berkshire is trading below its average price to book value per share of 1.39 times. So it's at a decent valuation in my opinion. And by the way, I'm using Fiscal.AI to come up with those charts. If you want to try it out, they give you 2 weeks of free access if you use my link in the description. But 1.3 times book value per share is really not bad at all. If you break it down in total based on the recent developments and acquisitions, you're paying $475 for Berkshire. You're getting about $184 per share in cash. You're getting about $134 in equity portfolio before a realization of taxes. And operating businesses like See's Candies and Geico and BNSF and all of them, you're paying $173 for that. The operating earnings, including the Taylor Morrison acquisition, is about $16.07. So you're pretty much buying Berkshire at about 10 PE, and you're getting the cash of $384 per share, and you're also getting the equity portfolio. So I think Berkshire is presenting a really good value proposition here at about 10 times operating earnings, and I expect operating earnings per share to grow about 8 to 10, potentially 12% with some buybacks. So, I mean, that's a pretty good deal in my opinion. And I still believe the stock's undervalued. And I don't believe it's going to underperform the S&P forever. Maybe the market is gauging what Greg Abel wants to do, what he's doing. And if he shows results and he could invest some of the cash position at attractive rates, I think the market will reward Berkshire in a major, major way. And that was my opinion on the company. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.